quickly put together a run through of what you're going to get once you become a paid subscriber. So I'm going to go through, so this is September the 15th, the weekly post, so the weekend post and the update to the portfolio that went out a couple of weeks ago. The overall flow of the post stays the same. The first section tends to be, an overall on the index. It's more, depending on what's happening, it can be more or less involved on that particular part of it. I joke and I post sometimes just a little fish emoji for my Just Keep Swimming, because sometimes, more so on the daily posts, not the weekly posts, but on daily posts, sometimes there's nothing to write. If we look at these periods here through the end of last year there was just nothing to write. All of this was green, the index was green, vol was low, so there's no need to waste my time, and especially waste your time, by writing some nonsense when it's, all these things are green, vol is low. Go and do something better with your time than reading some nonsense just because Chris feels like he has to write some words to justify the price of a Substack, right? It's not really worth the time for either of us. So yeah. But if we stick specifically to the weekend posts, so the portfolio updates. So the first section is generally about the index. As I say, it can be more or less involved. Just generally talking about the stuff that's going on specific to the index at that level, and then we get into the portfolio update. So this section here shows you the sectors, and it's as it exists inside the S&P 500. So it's not XLB, it's the 19 or 20 or so materials tickers that are in the S&P 500. It's not the 40 or whatever that are in XLB, okay? So per the S&P 500, so this is a measure of momentum. Bullish means both short and long are going up. Bearish means both short and long are going down. Long term, are going down. And then the rebounding correction is somewhere in between. So generally, let's say we track everything that's in bullish. Correction means that the short-term momentum signal is turned downwards, but the long-term is still going up. So it has a potential to just go in a circle like this until eventually it falls down into bearish. And then once it's in bearish, it tends to go backwards and forwards to rebound before eventually going back into bullish. So that's the measure of what the tickers are in the S&P 500 for each sector, roughly where they are in terms of rebound, bullish, correction, and bearish. So this section at the bottom shows the overall total percentage for all the tickers in the S&P 500, and then the slight shift below is so this just takes it by, is it bullish or bearish? This one says, okay, is it bullish or bearish, and how big is it within the market? Okay, so you can see that there is a slight shift. So you can see there that by market cap, we could say probably, there was more of the big, large tech names were bullish at this point. Okay, you can see the main difference here is in the rebound and the bullish. So this was on the 15th of September, so we were well into the kind of the bounce from the August vol blow up at this point. And this is just a description here of that. The next part is how that exists on my measures. So signal strength, we do 3 different measures of signal strength. The primary one is the 3-month. So that's the one that's shown here. We go into the other ones as is needed to show, whether it's a specific ticker or a specific sector. If it needs more clarification, that will be just part of the kind of additional posts. So we show week over week performance of the sector, month over month and 3-month. Percentage longs. So for me, a long means it's above momentum and above trend. Okay, so that shows you the percentage of longs within the sector. And then uptrend is this signal strength score in an uptrend or not? Okay, so that's a measure in between that. I normally give a bit of a, here I'm calling out energy. Again, where it's warranted, I'm not just going to waffle just for the sake of waffle because you guys are paying for it. That doesn't serve either of us. If there's something important, I write it here, and that's kind of, and this isn't a way of saying, like, this isn't a way of saying, oh, Chris is saying something, so it's important. I'm just trying to highlight that I'm not just going to start waffling about something. If I think it's important, or if I think it's interesting, it goes in here. It's not just going to be full of waffle. You don't have to try and dissect it and pull it apart, because generally if I write something in here, it's because it's standing out at that particular time. I'm not just going to put something in there again just to pad a post out. This will show where we are in terms of the index. Now, we do an equal weight portfolio, so each position is equally weighted at 2% when it opens. So this isn't by market cap. So by index means how much of the index, how many names of the index are made up by basic materials, so of the 500. So it's not by market cap, just to be clear, okay? Because I build a equal weight portfolio, so this is treated them as equal weight. So by index means how it exists obviously in the S&P 500. By rank is how we have it currently in the portfolio. This is again for the 15th, and then the delta is where the difference. So you can see we had underweights on materials, comms, energy, healthcare, industrials, and technology. And you can see we had a big overweight in discretionary, staples, and utilities. And then whether we have a cash position will be here. Then each weekend we re-rank, so tickers that have left, tickers that have been added, they all get re-ranked and they're put into this as in rank order. Now I put for each ticker I put the last close, because I calculate everything from closing prices, so I don't do any intraday position changes or anything like that. Everything is calculated on the last closing price. So you have the last close, the momentum value, and the trend value. We have a size here. All I'll say is a slight change that has been made from when we first started putting this together. So basically, if the price goes below momentum but stays above trend, it would go to a half position. That has changed now because there are more metrics that go into measuring. So there's other things like relative momentum. There's what's the volatility of the particular asset doing in comparison to the volatility of the index itself. So the VIX, or my measure of volatility for the index. It's not as cut and dry as it used to be, and there are pros and cons to that. Because of it, we do close positions. We hold on to positions a little bit longer, and has obviously pros and cons. One is we're not so easily shook out of positions when the overall index isn't having us, it doesn't have a blowout in vol. So if the overall index is suffering high volatility, then we act on our positions just a little bit quicker again, but it's measured by itself against the index. These things, especially some of the high beta names, can move around a lot. So sometimes they drop below momentum, and it was just forcing us to go, full position, half position, full position, and then, sometimes that was a signal, and that is measured. It's still captured. It's just, it doesn't come to you guys as often. So it's kind of done in the background, but that's the kind of thought process. So you have access to that, but just be aware that sometimes things will go below momentum, and that would normally signify going down to a half position, but that's just one of several metrics now that are in the background. Okay, so something may go below momentum here, Normally that would signal going to a half position, but each day when I send the general post out, not a full post like this at the weekend, but just the general post out, if it still says full, it's still full because it doesn't break the other metrics that I have in the background. But those are still there for you to use if you feel uncomfortable. If something's moved a lot and it's uncomfortable for you, then you have the levels that you can act at. This is just showing you the changes. So this was the portfolio as it existed last week, the previous week, and then this is the new position and how the positions have changed. So lots of cash. We went out of cash and added a lot of new positions on this week. Closed positions. So this will encompass all of the positions that were closed since the last re-rank. So if there were some positions closed midweek, not just, this would go out on a Sunday, so not just to be closed on the Monday morning, once the market opens, it would, on this day there was only Apple to change, there may be 10 or 12 tickers in here on this time, showing you the positions that closed. So I give a nominal value here, but for this, because this was gone out on the Sunday, this position Apple would have been closed on the Monday morning. So so sometimes these values are different to what it would have been perhaps on the market. And as I said, I use only closing prices. So for me, everyone can do whatever they want, whatever they feel comfortable with. After seeing everything go through the wash, I'd rather have my own time, and I just put market orders at the open. Yes, there's a better way to get better prices, and especially if you're running other people's money and you're using this as an example, there are much better ways to try and get better prices and whatever else. But to me, for my size of account, I'd rather just have the time than sit and managing orders and whatever else. So yeah, for me, no, I'm okay with that. So these are the positions as they exist after the weekend update. Chronological, so how long they've been in the book, measured by return, and then alphabetical. So depending on how your brokerage or how your setup is done, it's a bit easier for you to track the new positions. Then I go through the returns on the portfolio. So obviously we're comparing against the SPY. So why do I differentiate, and is it a bit of a Jedi mind trick? I mean, yes, potentially. So what I do is, so the blue bars here are the positions that have closed. And the reason why I separate it out is, for me, so this yellow bar, okay, so let's go through. So the blue bars are the closed returns, so the positions that we've closed and we've extracted a return from the market. The yellow bar shows for today what is the current existing open equity, all right? So let's see, so the closed return at this point was 21.8%, open equity is 29%, so we had, 7% in here somewhere, all right? So 7% return is still attached to the market, and that's the differentiator for me, okay? That 7% still belongs to the market. It doesn't belong to me yet, okay? It could go up. It could go up to 10%, or it might disappear within, one piece of news, one external impact to the market. It could completely disappear. So that's why it's not mine. It's not mine. It still belongs to Mr. or Mrs. Market, however you want to, however you want to declare them. So these closed equity returns, the closed returns, they're mine now. That's why I care more about them, because that's the return that I've managed to take. This is a pretty hard game, So for me, I am far more protective of what I have taken out of the market, okay? Because it's now mine. So that's why I differentiate between the two. The open equity, so that extra 7% or so that exists in the market, is just that. It's in the market. It's not a figment of our imagination, but it's there to extract, but it currently doesn't belong to me. Okay. And then the stop loss trigger. So all of the positions have an associated stop loss with them based on momentum, trend, volatility. So, you know, if there's some big market move, of course, there's going to be gap risk and all the rest of it. But as it stands currently, if all of the positions closed at their stop loss price, you know, we could potentially extract 25.1%, and that would be our return. We would be, you know, at that point would be all in cash. And then, so these, you can use these links here to get access to the dashboards, and I'll go through those now. Dashboard, this section, you know, I cut that out and use it in the post. The same for the momentum signal over here. And then what we have is every sector and subsector an individual ticker. So every weekend you can go through if there's a particular thing you look at that's, you know, different to what I post within the portfolio, or, you know, sectors that I'm talking about at any given time. You know, you can come and look at this, you know, and look at any position that you want to look at. So very similar, well, exactly the same really as up here, except instead of using percentage longs, you can see, so if it's got a bright green L, that means it's long. If we see down here, neutral is, again, it means it's below momentum but above trend, and blank just means that it's not a long. This system for me is, I'm just looking for things that are long. It doesn't necessarily mean take it as a short, you know, that's your prerogative. It just means that it's not a long. It means it's not a candidate for selection in the portfolio. So the next line, the bright green one, again, shows whether the 3-month signal strength is in an uptrend or not. Yeah, so you guys can use this to go through and look at any positions that you like. I may go, it's something to think about, of highlighting the positions that we currently have, but no, we'll see. But yeah, so you guys can use that and have a look at whatever you want to have a look at, and pick out, like, obviously energy. Everybody's chomping at the bit at the moment to pick up to buy energy, it seems. Right now, at least this week, we've made the pivot to materials. I don't really see many people talking about materials, at least in the things that I currently read. Everyone seems to be chomping at the bit, I guess, because it's down, so it's cheaper, and I'm doing inverted commas there, cheaper. But yeah, that's the main dashboard there. The 1 month and 3 month momentum scores. So as I said, the 3 month is the primary one that I show on the original dashboard, and that's the primary measure for the overall signal strength of the individual stocks. 1 month is used as a, what's the best word? A throttle, I guess, but I get 1 month momentum because it's shorter, it has a shorter look back, and it has a shorter window, of course, will react to something quicker than the 3 months. So, you know, what normally happens, a bit like the momentum, the kind of rainbow chart thing that's on the main post, things tend to go like this, okay? They tend to pick up 1 month momentum first, and then 3 months, they end up here, and then 1 month comes down first, and then they end up coming down this way. But it doesn't mean that, you know, something could go in a circle, just like you can go from bullish to correction to bullish to correction back down to bearish, so it could come down this way. So it tends to go in these kind of circular moves, you know, through its momentum cycle. And it doesn't mean that something could be down here and end up here and then very much fall back, okay? But it's just a way to see the different sectors. Some of the charts are messy, obviously. Industrials, tech and financials have by far the largest, you know, they have between 65 and 75 names in them, so you may not be able to read everything, maybe able to find particular stocks that you're looking for. But again, if there's something particularly you want to look at, you can just, you know, just comment or reach out in the Discord or whatever, and I'll do what I can to try and pull a particular one out if there's something interesting. So there's that. The third dashboard that I share is this one, which is the messiest, is the most confusing, but the more you use it, it does become helpful to look at. So obviously, okay, we've got each individual ticker. So not only are we looking at all 500 stocks on this chart, okay, as we can see, all 500. Not only are we looking at all 500 stocks, but for each stock, we're looking at 3 different charts, basically, okay? So we're looking at the signal strength. So blue is 21 day, 63 day, and 128 days. So basically 1 month, 3 month, and 6 month, okay, signal strength. So the red star, which is the current score, gives us, you know, so for this, so APD, if we went back to the other chart, APD's score would be something 0.55 or 0.6, something like that, okay? And then the other 2 are here. So what we're doing, think of ourselves as we're looking down, if we stick with APD, okay, we're looking down the edges of 3 sine waves, okay? So the stars are the current values of the signal strength. And then the dots are a kind of are an average of where it's peaked within the last 3 years. Okay, so generally the blue is almost always +1. That's the maximum value because it moves from max to min far more. Okay. If we go along, if we just look at yellow for instance, okay, if you look here. So Newmont, okay, so in the past, and it looks like it's currently rewriting it here, okay, because it's above it. In the past 3 years, the top in the 6 month signal strength score has been around 0.5, okay, and you can see that it's currently rewriting it. So at some point, if Newmont does have a pullback, okay, the score will change up to wherever it's. So if it starts going into a downtrend today, this yellow dot will move up to somewhere 0.75, let's say. Okay. Like I say, obviously the 6 months doesn't move as fast as the 3 month, doesn't move as fast as the 1 month. So generally, the tops in the 1 month is almost always maximal. Yeah, and then we have some measure again. Most recently, I've been highlighting, say, bonds, starting maybe a month ago. But what we've seen most recently is, so they were getting to a point, so here, like we just went through Newmont, where bonds were at this maximal levels, where they've topped out in the past, just as is happening with Newmont again here. It wasn't a point to then run for the hills and close out all of your bond positions. You know, we still had a lot of long bond proxies, so utilities, etc. You know, it doesn't mean that this is the top and you have to do so. It's just showing you a point in time where maybe I need to buy some puts against my bond positions or whatever it is. But as is happening, as a direct example with Newmont, this previous 3 year kind of average top out point, again, is an average. It's currently being rewritten. It's going to be moving higher wherever Newmont does start to turn downwards. That new value will then form part of the average and it will move higher to use as a reference point for the future. So if we take something like Google, you can see that the 1 month is at a maximal negative, so it's at -1. The 3 month is also very close, and the 6 month is somewhere in the middle. They're kind of perfect, and this is why something like energy, which we pointed out a moment ago, if we see down here Halliburton as an example, VLO as an example. Where this could be much better than something like Google is all of these, on every metric, the signal strengths are almost at a maximal negative score, right? So what, that would be the perfect, and we don't always get that. But what you want to see is eventually EQT, which is something that's just creeping up into the view, is okay. So whatever, 2 weeks ago, this blue star would have been down here, and it's overtaken everything, okay? And it's coming from a low value, so that's a potential one that's going into the portfolio soon, is probably EQT, maybe BKR as well. But what this does, so really what I'm trying to say is that this chart, even though it's messy, once you start to get used to looking at it, it can show, again, it's showing you 500 tickers and effectively 1,500 charts just in one dashboard, right? So you can go and have a look, because if we use the other example of something like utilities, if we look at utilities, look at how pinned everything is. And it doesn't mean this is, oh, well, we must have to go, we start selling our utilities positions and weakening up, but you can see almost everything is a maximal value here, right? Or really close to it. So this is where we can see that something is perhaps overextended, or maybe it's not. It's just okay, yep, all of utilities is doing great. The other example is real estate looked like utilities did, maybe 3 weeks ago. Well, now there's stuff starting to break down, okay? So we already had things in here in residential from the old chart. It's not moved a lot yet, but some of these things have already started to move down. Staples is a good example. Staples looked very much like utilities maybe five weeks ago, and those things have all started to break down. Not all of them, many of them have started to break down, okay? So again, it's just something to view to show maybe places where we should look, both to protect ourselves. Okay, we still have a large overweight to utilities at the moment, which is currently doing well, not as well as other things, but utilities was doing well at the same time as these other sectors, which have started to break down. Okay, so if we take as an example utilities and energy as it exists right now, those would be the kind of opposite sides of a coin, okay? If a utility has to buy natural gas to sell it to you as electricity, well then, if energy starts doing well, it may start impacting the margins of utility companies. So that's some way, okay? That's perhaps a way to look at this, the two sides of one coin. Last chart that makes up the 4 charts that I share every weekend is this one. So we still go by sectors, but instead of individual stocks, because this is a pretty this is a pretty hectic chart anyway. But I did put it out by individual ticker, which was a bit looked a bit crazy, so much so that you couldn't really get any information off of it. So I broke it down into the subsectors. So unlike most charts, this column on the left hand side is the most recent data going backwards in time, and hopefully what it tries to show is so again, this is the 3-month signal strength score, but it shows how that's changed through time. So we can see most recently something like insurance, so you can see how it's slowly changed over time, and it started to pick up and had positive signal strength score, going back to, let's say, the middle of August. Something like reinsurance, had a brief period and then fell back again, before picking up and maintaining signal strength. So again, it shows all the sectors. You can see here, like healthcare has been very strong, starting to cool a little. There's specific sectors within discretionary which have done well. Real estate, you can see it's just about starting to go a little bit lighter here. The sectors of utilities that are still strong. The producers here. Utilities is actually quite an interesting sector. I highlighted it earlier with the differentiator between energy. But even within utilities, what MSCI has deemed to be a utility, which is CEG, which is Constellation Energy, that very much acts on its own. And there's another one, NRG. I don't know what the actual company's name. They very much act like high beta. So CEG in particular is far more linked and has a higher correlation to something like the high beta trade. So it's actually a good, internally. I spoke earlier about the two sides of the coin with energy and utilities. Well, even just within utilities, renewable also has that. So CEG has that as well. That it's normally, if CEG is doing well, which it has recently started to, it's very much unlike the rest of the companies that are in utilities. But you can see that's something you can see here. So when so CEG was doing well still while the main parts of the sector were doing poorly, and then it's done poorly while the main sector has been very, very strong. Renewable, as it stands here currently, in the S&P 500, that's just one stock, whereas this gas and utilities is 12 or 13 individual companies. So you can see that it's very much uncorrelated. So hopefully that goes through. Sorry, this last piece, this is just the overall, so the total within the S&P 500. You could see, as we were going through June, there were just a few companies that were holding up the vast majority, mainly tech, some of the big names in tech. And then when those started to weaken, larger portions of the index were starting to pick up the slack. So that's hopefully a primer for people who are new subscribers, and maybe people who've been subscribing for a while have learned something new today. Like I said, please ask questions. Lots of this things, obviously because I made it, is very intuitive to me. One chart may be a simplification of 10 others that I look at. So please, if stuff doesn't make sense, or you need clarifications on something, or you have hints, you think something might be presented in a better way or a different way, or anything like that, please leave comments, reach out on the Discord. I very much want this to be a collaboration. So there'll be stuff in here. Purely, it might just be purely all I want is the tickers that make the portfolio, and that's it, and that's perfectly fine. Of course, that is. But ideally, what I'd hope is that there's, like I say, a collaboration between the subscribers and myself to try and not only make the product better for everyone, but for me to learn stuff along the way, you to learn stuff along the way, and build out extra things, together. That's the plan. Many minds are better than one. That's the idea. So yeah, again, thank you. If you are a paid subscriber, then thank you very much. If there's any new potential subscribers out there, and again, some stuff still doesn't make sense, then reach out to me wherever you can, on Twitter or Substack or posts or anything like that. Reach out, and I'll try and do my best to explain it. Thank you very much.